Well, hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. It's a brand new week and a turbulent start is what we can expect, given the fact that we had escalation, between Israel and Iran over the weekend. And that could play out on the Lal Street as well. Asian markets, of course, are trading in the red. All the US futures have recovered, some bit of ground after Friday's sell-off. Looks like all the risks were already priced in Friday's sell-off. But of course, as I mentioned, GIFT Nifty hinting at a triple-digit cut on the Nifty. The Nifty spot on Friday shut shop at 22,500, which is down 234 points. So today as well, we could see a triple-digit cut coming in. The India VIX, that's the volatility index, was up nearly 4%, and we could expect a spike in volatility today as well. Well, lots of cues to watch out for, but to understand how things are looking like for commodities like crude and gold in the wake of escalating tensions in West Asia, I'm joined by Peter Mcguire, who's the CEO at Exide Australia. Great to have you on the show, Peter. First of all, crude has been range bound this morning, around that $90 per barrel mark. Do you think all the risks have already been baked in? And if there is no further escalation between Israel and Iran, would you expect crude to stay around these levels, or would you still say that $100 could be a possibility?
Well, Nandita, lovely to join you from Sydney. I think there's so many components to this. You've got possible supply disruptions, where we are as far as, the geopolitical situation. This is just a work in progress. We need to see retaliatory, what happens as far as Israel. We need to see other participants across the Middle East. I just saw Karg Island has been attacked from Iraq. So all of these sort of moving parts need to absolutely be absorbed into the market. And then we look at price, and price is the true performance metric. And I would say that you probably, with this time of year, I wouldn't be surprised to see it edge up higher than where we are at the moment.
Right. What about gold? It has seen a spectacular run. On a YTD basis, gold prices are up almost 15%. Do you see chances of the yellow metal hitting 3,000 in the near future amid safe haven demand?
Well, I think there's just, the appetite has been dramatic as far as central bank purchasing over the last couple of years. That's nothing short of mind-blowing. And you're looking at China's appetite has just been off the charts, followed closely by Turkey and India. So there's the first part. Then you've got domestic demand has been incredibly hard as far as retail land. And then and the likes of Costco selling up to $200 million worth of gold per month. Then you've got the other side of it. We've had such a strong rally to the upside. I think that momentum will continue. And so, yes, 3,000 could be a stretch, but if you ignite geopolitics behind it, then really that possibly could be a price target.
Right, hold that thought, Peter. I'll come back and talk to you about other metals as well. But markets have opened here this Monday morning. We are seeing a triple-digit cut on the index, as was being expected. 150 points, in fact, 160 point lower for the Nifty, below that 22,400 mark as well as we speak. But let's see what other indices are also doing. The Nifty Bank Index, I want to pull up how the Nifty Bank Index is faring right now. It has snapped out of a 6-day gaining streak. 400-point cut coming in there. 48,000 is holding, for the Bank Nifty for now. Let's pull up the metal pack as well. There has been a spike in prices of aluminium, copper on the LME on the back of the US-UK ban on Russia metal. So metal pack has also ended in the red. So looks like it is an across-the-board weakness on the Lal Street this morning. The Nifty IT pack also, in the red after TCS's good performance. That is also not being able to support the market. We are seeing a negative open. The Nifty Pharma pack also, down by 1% or thereabouts. So it's across the board sell-off that we are witnessing on the Lal Street. Not a single sector in the green as we speak. And the Nifty, of course, down, in triple digits, and Sensex as well has given up that 74,000 mark as well. So all in all, a weak open. Let's just quickly see what the individual movers are on the index. Gainers are few and far between. UPL is the top Nifty laggard. Sun Pharma, HDFC Life, BPCL, Tata Motors, Tata Consumer, Wipro are among some of the top losers on the index. And as I mentioned, gainers are few and far between. Hindalco, ONGC, Nestle India and Bharti Airtel. TCS also marginally in the green, but the numbers were fairly strong, given the kind of expectations that we had. Although revenues were, flat or, modest, saw a modest growth. All margins and deal wins were the key takeaways from the TCS numbers. But Peter, talking about the metal pack, there has been a ban on Russia metal from US and UK, right? In the wake of that, we've seen aluminium, zinc, copper prices surge, on the LME. Going forward, copper was already at 15-month highs, if I'm not mistaken. Do you expect more upside from here for all these metals that I mentioned?
Well, as you said, I mean, Friday was just a very, very strong day. If you're looking at, between 2.5% and 1.5% up, if you strap it across aluminium, copper, nickel, zinc, tin was very, very strong. So, Nandita, I think that when you're sitting at 9,500 a metric ton for copper, it's had a very strong rally from that 86, 87. It really was in no man's land for such a long period of time. We got down to nearly 8,000 a metric ton. So we're entering a bull market mentality in the sense of being up 20%, and we're very close to that. So the overall momentum across the base metal market has been one of very, very strong dynamic growth, and I would say that it's probably going to continue in the short to medium term. So yeah, strap yourself in. It could be a very, very good, strong move to the upside.
Right, that's the view then on the base metal pack. But I'm afraid, Peter, we are running out of time. We are a little strapped for time this morning, but I wish to have a longer conversation with you sometime soon. Thanks a lot for taking out time and joining in this morning.
Thank you, Nandita.
Well, with that, let's see what the markets are doing. Of course, as I mentioned, 200-point cut on the Nifty as we speak. The mid and small cap indices are also deep in the red, with the mid cap index down over 2.5%. On that note, let me also bring on board a technical expert for today. Joining me is Brijesh Ail of IDBI Capital Markets. Great to have you on the show, Brijesh, I beg your pardon. Well, we've seen a 200-point cut on the Nifty. What is the floor that you would be watching out for in today's session, and on the Nifty Bank Index as well? A 6-day winning streak has been snapped. So what are the kind of levels you'll be watching out for on the Nifty Bank Index as well?
Hi, Nandita, good morning. So I think, last Friday we saw a correction of almost 200 points on the Nifty, and now it's almost another 200 points. So we are already done with the 400 points of correction in the Nifty as of now, and we are now back to the demand zone of 22,300, 22,200 mark. So I believe whatever the panic has to be done, it's already discounted in the market. So we are maybe another 100 odd points corrections we might see in the Nifty, but then this is the level where we can again look to re-enter the long positions. We will wait for a while, maybe another half an hour, 1 hour's time. Once the market cools off, I believe we are already in the oversold zone from the hourly charts, and this is a truncated wick. So, and since we are already corrected at the start of the day, closer to 22,300, 22,200 with a very stock specific approach, I think we should be again viewing to take the long position, because directionally the trend for the Nifty is positive. This week might be a kind of a range bound kind of a session, but then a decline should be viewed as a buying opportunity. And if you ask me for the Bank Nifty, we saw a very, very strong breakouts in Bank Nifty at the level of 48,000, and now we are back to that point. It's a weekly breakout. So, and Bank Nifty, we can easily fetch for 50,000 level on the higher side. So it might take a little bit longer time, but I am pretty confident that once this news cool off and then the market settles, we will find some good buying interest in the market, and the market should recover from the current level.
All right, buy on dips remains the strategy. Hold that thought. Brijesh, we'll come back and talk about specific stocks with you as well. But also joining me is Sahil Kapoor of DSP Mutual Fund. This morning, great to have you on the show, Sahil, as always. But, talking about the direction that the market has taken, of course, we are seeing a 200-point cut in the wake of rising tensions between Israel and Iran. But we've navigated quite a few challenges, right? With crude coming back to 90 and, of course, diminishing chances of a rate cut by Fed, early rate cut, so to say. And, we also had the SEBI diktat, but we have navigated those challenges, and we've seen buying on dip coming in at all, whenever we saw all these challenges. But do you expect buying on dips to continue here on, and any volatility? Would you advise investors to look at that as a buying opportunity?
So largely, thanks for having me. I think market is still in a range where, on valuations, it is not very cheap. When you look at the long-term, numbers, so we were looking at one specific number. If you look at the small and mid-cap space, the median price to earnings multiple has gone from 20 at the peak of 2007 boom to about 40 now. So markets have become expensive. Even if you look at the broader market, the trends have slightly changed. So the dynamic that you pointed out, if you look carefully over the last 2 to 3 months, what has happened is uh, before, let's say, January 2024, the smaller the stock, the bigger the rally was. So if you go to, let's say, a micro cap index and then come up the curve in terms of from micro cap to small cap to mid cap and then to large cap, you will see that smaller companies are outperforming the larger ones. But look at what has happened over the last 2 months. Nifty has made a new lifetime high repeatedly. If you look at, let's say, mid-cap stocks, the rise has been there. They have also reached lifetime high, but the percentage changes are much lower. Small cap is barely above its lifetime high. Micro cap did not make a lifetime high. And as you go down the ladder, you will see that the breadth is sort of not as strong as it was in the previous rally. So one thing is clear that the market is sort of losing its broader luster of many stocks doing well. Second and more important thing, as I said earlier, from a valuation standpoint, we continue to trade in between 80 to 95th percentile of valuations, which means that in the expensive zone across market capitalization, larger stocks are slightly more better relatively, but they themselves are not very cheap. So my guess is, as you said, we've navigated a number of events, but as and when we see new triggers come in, and if the markets are expensive, it does make you more cautious in approach as you go ahead. And I think we should probably be looking at this market from one standpoint, that it has discounted a large number of positives. Can it take away or can it digest negative news and continue to rally? I think now, looking at the complexion of the market, that could be a big challenge.
Okay, in that sense, you mentioned that valuations are on the expensive side. So where should one really look for, value? Autos have seen a good run. Realty has outperformed by leaps and bounds. Which is that one pocket that one should look at investing now at these record levels?
So there are 2, 3 pockets, I think, not just one. So when you compare, let's say, the broader market, as I said, trading at rich or expensive valuations, but look at the large part of the market. 35 to 40% of the profitability for India comes from the BFSI sector. And when you look at specifically, let's say, lenders, they are trading below their long-term average valuations when you compare it to price to book multiples. Their earnings growth is still strong. NPA cycle is very low. So I think from a valuation standpoint, that is a sector which probably offers a much larger margin of safety. And secondly, as you said, auto has seen a large rally, but I think there is a number of parts within the auto space. When we talk about, let's say, PVs or MNHCV or two-wheelers, I think there are segments in which a churn is happening. Probably the two-wheeler space appears to be much better in comparison to earlier what PVs were looking, but auto continues to see a sort of a promise over the next 3 to 5 years that top line growth will be there, right? And most of these companies are very cash rich, efficiently run. If they're able to take maybe a quarter or two of let's say poor growth numbers also, I think this sector appears to be in a good long-term trajectory where you can have a number of opportunities. And third, of course, is the healthcare sector. We've seen a largish rally unfold over the last 1 year. Valuations have now come close to average levels. They were very, very depressed earlier. But I think this again is a sector where things are changing. So if you, let's say, put all the sectors together, there are only 1 or 2 sectors where top line growth, bottom line growth, both are rising. They are not falling, which is all these 3 sectors, which I think gives you a lot more comfort in terms of margin of safety.
Right. Of course, TCS has set the tone for the earnings season, right? Management commentary has been fairly positive, and they expect growth to come back from the second, quarter of FY25. Would you say that a lot on the revenue front has already been bottomed out, and Would you advise investors to play IT on, on the earnings theme, or would you say wait it out for a couple of more quarters, let some recovery kicking in, then look to enter?
I think on a relative basis, we don't think there is still a very large amount of valuation comfort. Let's say, when you look at many companies, for example, the bellwether reported numbers, look at the last 2-3 quarters, the top line growth has been barely about 1% or so. Last 8 quarters, average sequential top line growth is just about 1.2%. Even the YOY growth is just about 2.2%. Margins were absolutely good. I think 100 basis points up margins. But largely it's a function of how they've traversed their cost. From a growth perspective, I think there is still not too much clarity. How will it unfold? So it is still better to adopt a wait and watch approach in this sector and see how things unfold, because the clarity from most verticals that demand is coming back, I think, is still absent. So it will be much prudent to wait and then take a call much later.
Right. Okay. Take a call a little later. That's the call on IT. But what about metals? They have also been shining bright off late. In fact, if you look at prices of copper, aluminium, they are rallying this morning on LME. There has been, of course, curbs by US and UK on Russian metal. Copper prices were already at 15-month highs, and we've seen a rally play out on shares of Hindalco, Tata Steel as well. So, would you still be cautious on metals, given the fact that a lot depends on China recovery? Although the manufacturing numbers were pretty, encouraging, but a full-blown recovery, is still some time away, given the kind of pressure the realty segment is witnessing in China. So, would you still be cautious on metals, or would you say that this rally has more legs?
So, Nandita, the right answer for me is that I'm a little confused, right? When you look at the drivers for why metal prices should go higher, apart from the geopolitical things that we are looking at right now, and plus a number of, let's say, ban which we've seen in last 2-3 days, LME announcing a ban, etc. They have actually put a bid below the base metals, whether it is aluminium, zinc, copper. Some of these prices they just appear very good on charts, but I think they still miss that underlying factor where demand side levers are not present, right? Supply side is something which is completely unpredictable and can take prices higher. So I would say I'm not very sure whether demand side triggers are strong enough for these metal prices to continue to move higher. For me, I think it will be much better to focus on precious metal rather than base metal, for the simple reason that underlying demand scenario for base metals still appear to be very shaky, and therefore I would not put a lot of strength behind the current rally. It looks like a more tactical, play on certain short-term events, but for the longer term, I don't think there is a significant upside that we can expect.
All right. What about PSUs? Is there still a case to invest, especially the PSU defense companies? We have seen intermittent corrections, but, we've seen renewed rallies as well, right? Those corrections have not had, much legs, right? So here on, would you say defense PSUs warrant a look, or do you think valuations are still at elevated levels?
See, we have been investors for a very long time in this theme, and I think that it's still a very long vintage theme that it can continue to do well. But as you said, we have to be very cognizant of valuations, particularly in the defense sector. I think it has discounted a lot of numbers for at least FY25, FY26. So you have to be very careful how you enter these segments. If you are already an investor and you continue to hold them, then possibly it could play out for you very well. But from a fresh investment point of view, I think we'll still sort of wait and watch and see how things pan out in the overall scheme of things. Earnings growth continues to be very strong for this sector. So I think the underlying trigger, whether it is top line growth, earnings growth, good margins, good balance sheets, all of them are present. With an eye on valuations, I think you can find opportunities in this sector. But currently at this prices, I think we'll have to be a little cautious.
All right. Last question really, Sahil. What about the FMCG pack? We've seen continued underperformance, but there are expectations or forecast of a normal monsoon. Here on, would you expect things to stabilize with respect to demand? And, do these stocks warrant a look, given the fact that valuations may have become a little cheaper due to the continued underperformance that we have seen in this pocket?
So valuations have, they have come down. There is no doubt about it, but not enough, right? Valuation decline is not enough. Many of these companies are still trading at 40 to 60 time multiples, which is not very attractive. Some of the companies, let me tell you from a bottom-up perspective, I think they are qualifying within their normal average valuation bands. Plus, we are seeing some signs that volume growth could pick up. And we wrote about this in one of our reports last month, saying that there are certain signs in this sector that probably things are, getting back to some amount of normalcy. And whether it is volume growth, some companies have started to report that a part of rural India is beginning to come back. That could be really helpful for this sector. And second, margins which have been hit significantly, they could get some boost because agricultural commodities, saw a decline. Although in the last 10 days, we've seen again an uptick. But net, I think there are certain signs that this sector could be a relatively better play. But again, we can't paint the sector from a top-down perspective. I think there are 3 or 4 firms, companies in this sector, which probably are appearing in some of our baskets where valuations are becoming attractive.
All right, but one more question I would like to pose it, and it's about all the sectors that are related to crude, right? Crude, of course, is around that $90 per barrel mark. Do you expect crude to inch higher from here, given the kind of volatile situation in West Asia? And secondly, how are things looking for pockets like OMCs, paints, tires, all these sectors which are dependent on crude, so to say? What is your outlook on these sectors?
So largely, as you said, I think it's a function of the oil price. And as you know, it's anybody's guess where oil will go. From a purely demand supply perspective, I think there is a lot of supply at $85 to $90. Uh, for example, when you paint the current picture, let's say if new sanctions are imposed on Iran, which already is under sanctions, and if the supply from Iran is curtailed, uh, I think Saudi Arabia can take up at least between 1.5 to 3 million barrels a day of supply cut. It can ramp up and probably help prices. Even Saudi has indicated that they would want oil price to be between $85 to $90 or higher. So my guess is that there are enough supply side levers as of now, but how much these tensions escalate is what is going to decide the oil price. Um, and let me tell you that all the things which are unfolding right now, given the demand supply scenario, if you get a higher supply shock, oil prices can surprise on the upside. So I'll be slightly more cautious on how oil prices pan out because the kind of geopolitical tensions that we've seen, they have not really de-escalated over the last 6 to 7 months. This is possibly a larger second escalation. We are no experts in calling out how these things will pan out, but it does give you an indication that you have to be more careful with the oil price. If it goes above $100, it can really hit the sentiment. So I think we'll be careful in the short term.
All right, some bit of caution warranted when it comes to oil prices and therefore all the crude derivatives as well. You should tread with caution. But with that, Sahil, thanks a lot for taking out time and joining in and sharing your insights with us. Always a pleasure chatting with you, and I look forward to having a longer conversation with you sometime soon.
Thank you very much.
Well, with that, let's go back to Brijesh, who's been waiting by very patiently. Brijesh, I want to get in your thoughts on a TCS, given the fact that numbers have been pretty good. We've got brokerages also, some of them upgrading the stock. In fact, JP Morgan has upgraded the stock to overweight with a target price of 4,500. Vis-a-vis earlier target of 4,000. Couple of other brokerages have also increased the target price on TCS. Of course, in a weak market, it's holding out. The stock is up 0.5% right now as we speak. What are the levels you'll be watching out for here? Would you say that it is poised to clock in levels of 4,200 in the coming sessions? Brijesh, I think you're on mute. I'm not getting your audio.
Yeah. So, I do believe the structure for the TCS is positive. The 50-day moving average for the TCS is at 40,040 level. So I do believe that once this level is taken out, and it looks like it will be taken out. So 4250, 4300 would be the immediate, maybe another 10-15 days kind of a till the end of this expiry. I think TCS has the strength to go back to 40 to 50. So I think the structure is positive. The recent swing low of this 3900 should be the levels which should be watched as a stop loss. And I think today in this dull market, after the post result, it is performing. So more or less, it will sustain. So definitely for 40 to 50, one should play this move.
All right, 40 to 50, that's the kind of level to expect on a TCS. But let's also talk about some stocks that will be in focus due to the increased, geopolitical concerns around the Iran and Israel, tensions that have been playing out. Adani Ports, that's one stock in focus, given the fact that it owns a Haifa port in northern Israel. In fact, it completed the purchase in January for about $1 billion. And a broader escalation in the conflict, may make critical infrastructure with Israel a potential target, right? So on the charts, Adani Ports today it's down 2.5%. What is the next support we'll be watching out for here?
So today, this Adani is almost to the support of 50-day moving average, which is at 1300 mark. 1304 is the exact value. And if you observe lately, during the mid of March, it has made some low at 1200 mark. So on the maximum part, the stock may come to 1200 on the lower side. But that all poised whether we see it closing below 1300 mark. But then if I look the structure from the weekly and monthly perspective, there is not lot of damage which I can see. There is slightly maybe because of the market overall, the sentiment, the stock is coming down. But then closer to 1300, I think there is a demand. So only if 1300 is broken, then next there is a demand by another on the lower side, another 100 points. There is another support zone, but there is no much of a downside. I would be confident to take the longs whenever it comes to almost it's 1300 mark, 1310 mark. So close to 1300 or 1290. If I see those levels, I think I should be taking a long trade because I think it can easily go back to 1400 on the higher side.
All right, that's the view on Adani Ports. But let me also remind our viewers, we'll be taking up all your stock-related queries with Brijesh. So if you have any queries, shoot them in on our YouTube feed. We'll try and take them up. But Sun Pharma, that's another stock that's in focus this morning. Of course, it's subsidiary Taro is an Israeli company. But the risks due to the escalation is fairly limited when it comes to Sun Pharma. However, there was a setback in terms of US FDA ruling as well. It has tagged one of its plants as official action indicated, which is why the stock saw a good 4% fall on Friday, and it's extending its losses today as well. So on Sun Pharma, is there a trade, or would you say that if you have any positions, book your losses?
Sun Pharma, there is doing distribution on the Friday. Clear-cut sell-off we saw, and the sell-off has been followed by the selling volumes. So, and it has broken the 50-day moving average. So definitely for the time being, the structure, at least for the next 10-15 days, the structure has been spoiled. So I think we'll be talking of 1450 on the lower side, more 70 point from the current level. So anytime when there is a pullback in Sun Pharma close to 1550, 1560, so somebody's got stuck in Sun Pharma from the expiry point of view, I think one should take the exit, and given an opportunity, if somebody wants to take a risk, can also go short close to those points. On the way up, 1610, 1615 will be the stop loss if somebody takes a short position. And I think, I believe that gradually slow and steady 1450, 1430 can be the next level to watch on the Sun Pharma. So view remains bearish, and profit booking is what we can see. So further correction is likely to be seen in the Sun Pharma. So exit on bounce.
All right, exit on long. That should be the strategy on Sun Pharma. But with that, let's take some of the viewer queries that are trickling in this morning. Yagnesh wants to know whether one can look at entering Britannia at current levels. Now, Britannia on a YTD basis has shed over 11% over the last 1 month as well. It has seen a fair bit of selling pressure. Would you advise, nibbling in at current levels?
No, Britannia is looking weak on charts. There is a continuously selling from the start of this year, from the month of Jan. Itself, the stock is correcting, and it's in a lower top, lower bottom structure kind of a formation. And if we figure out the base and support level for the Britannia do come somewhere close to 4,400 mark. So I think there can be a further damage in Britannia. There are no triggers which say that this can be a bottom fishing or some value adding can be done. Uh, Easily we can talk of another 300 odd points on the. So whenever it comes closest to 4,400, if somebody wants to take a long-term view or maybe positional trade, then that is the area one has to keep a watch on. Definitely avoid at current price. Wait for further a little bit of more corrections in this.
All right, hope that answers your query, Yagnesh. But Satya has written in, he wants to know your thoughts on Motherson wiring with a 1 to 2 year perspective. Would you advise entering? Because the stock has done fairly okay on a monthly basis, 6-month basis, but off late in the last 5 to 6 sessions, we've seen some bit of selling. Would you advise a look for 1 to 2 years?
Okay, maybe from a very long-term perspective, we can't. But what I can say is that whatever we do, if, the levels of 60 or maybe on a 58, these are the demand zone. By any chance, if things doesn't work out and this 58, 60 levels are taken down on a closing basis, and if the market, if this particular stock doesn't move above it, then if a little bit of cautious or maybe review your positions when those levels are broken down, because that is the multiple demand zone. If that doesn't needs to be broken down, but by any chance if those levels are broken, be cautious and then take the view accordingly. But right now, yeah, okay, from the long term perspective, one can take a bullish view with the stop loss of 58.
All right. I hope that answers your query, Satya. The next query is coming in from Alex, wants to know your thoughts on Bharat Dynamics. After 70% surge over the last 6 months, of course, we've seen some of the defense stocks cooling off, and Bharat Dynamics, is one of them. So what is the support one should be watching out for here? That's what Alex wants to know.
The range of 1600 is a base for the BDL, so Bharat Dynamic, and it's in this particular stock is in the uptrend. So I think maybe with the market there can be some slight corrections close to 1600 mark, which should be viewed as a buying opportunity, because in the near term this BDL can easily go back to 2000 mark on the higher side. It will take a good amount of time. But then this opportunity should be viewed as a buying opportunity, and 1600 is the maximum just in case, because this was the level previously the Bharat Dynamic corrected, and exactly from those points it has seen a very sharp reversals. Demands have been seen at those points. So in extreme scenario, 1600 might be seen, and again those should be viewed as a buying opportunity, because near term I believe that this can go back to 2000 mark on the higher side.
All right, those are the levels to watch out for in Bharat Dynamics. Hope that answers your query. Couple of more queries that I want to take up. Peter Williams wants to know your thoughts on Exide and whether it's a good time to enter for the long term. Of course, Exide is one stock that has been on a tear. If you look at the last 5 sessions itself, it has gained over 25%, and today it has exited the FNO ban as well. The stock is up in a weak market, 2.5%. Would you say wait out for declines before entering?
Yeah, so basically in today's market also, from the derivatives point of view, there is a long build up in Exide, and definitely there has been a delivery volumes which took place over the last 3-4 days, and one would wait for some slight correction close to 380 370 mark, which remains again the buy trade zone. So it's a buy on decline kind of a structure. The overall the yearly formation and the quarterly formations are positive. So this continuation of the momentum will be there. So recently the stock started from the levels of 300 to 420 mark. So we can easily bet for another 100, 120 points from the current level. So maybe from the levels of 380, we can talk of 480, 500 marks on the higher side. So maybe somebody doesn't want to wait and wait for this decline. 50% can be bought at current level, and another 20-25 points lower, they can re-enter the further balance position, and would bet for 500 levels on the higher side.
All right, that's the view on an Exide. But last query really for the day. This one is coming in from CK, and he wants to know your thoughts on Tata Power as to whether it's a good entry point at the current level. Today, the stock is down 3%. Should one use this dip to get into it?
Definitely, Tata Power is one stock which is now turning into very strong positive territory. And anytime, whenever we see a correction in Tata Power, it's always a buy. From the support point of view, 375 is a very strong base. I don't think anytime whenever the stock corrects, it will trade below 375 mark. If somebody wants to take a very long-term view, I think it's very strong bet. We can easily talk of 550, 600 level on the higher side. If somebody who want to take a trading opportunity, wait for slight corrections, maybe closer to 400 mark, 400, 410, that would be the level where one should take the long trades. Or that's a perfect trade, and major support do comes at 375. Only the entire structure will go negate if 375 levels are broken down, which looks unlikely as of now. Wait for small corrections, maybe another 10-15 points, and it's a very good, very strong long-term bet.
All right, a very strong long-term bet. That's Tata Power for you. But since there's one more query that has come in, I'd quickly like to squeeze it in. Although it's a new listing or recent listing, so to say, Aarata. That's one stock that we keep getting queries about. The stock is down 6% today. Would you advise a buy, because over the last 5 sessions it has shed nearly 13%. Should one use this dip to get into the stock?
It will be slightly difficult. I think from the long-term perspective, yes. But somebody who wants to take a deal, playing for that small trading move, then it's quite not that comfort is not that. But then from the long-term perspective, somebody wants to take a view. Yes, we can take that view because there can be further. We can see a little bit more damage in the counter. It will be very. We can't exactly judge how much that can be, but then long-term perspective, yes, if you somebody wants to take the trading bet or something because if the stock is corrected, I would say no.
Okay. All right, that's the view on Aarata. Hope that answers your query. But with that, I'm afraid we've come to the end of the query segment. If we couldn't take up your query, don't worry. You can send them in to us tomorrow on our YouTube feed and we will try and take it up. But with that, Brijesh, before I let you go, what are your recommendations for viewers for the rest of the week, or with the medium-term view, what would you be keeping on your radar?
Actually, I will be betting more on the mid-cap space. So within that, Borosil Renewable is something which is looking good. Eventually, for the last week, there was a good conservation seen in those stock. So today, the stock is down by 17 points. I think this is a beautiful trade. With the stop loss of 500, I think Borosil Renewable can be taken as a long position for the target of 630, 640 on the higher side. This is a positional bet, not to do with the trading or something like that. With the stop loss of 500, one should go long. Next one, which I had in my list, was Poonawalla Fincorp. So eventually, this stock has also seen a good volume breakout of the loss. There is a good accumulation which saw a breakout. Today, with the market, it is down. I think this again a very good opportunity to re-enter longs with the stop loss of 450. We can talk of 550, 560 on the higher side. And lastly, the CDSL is something which is again very strong positive. It has seen a very good volume in the weekly time frame. And Friday, there was a very good breakout. Today's stock is down by 60 points. I think it's a beautiful point to re-enter the long positions. With a stop loss of 1840, 1830, one can take this long and we can talk of 2100 level on the higher side.
All right, these are some of the recommendations coming in from Brijesh, Borosil Renewable, Poonawalla Fincorp, as well as CDSL. But with that, Brijesh, thanks a lot for taking out time and joining in this morning and sharing your thoughts and, of course, addressing all our viewer queries as well. Wish you a good trading day ahead.
Thank you.
Well, with that, we've come to the end of this edition of Opening Bell. Of course, we are, leaving the market with a triple-digit cut. In fact, 200-point cut on the Nifty. It has even slipped below that 22,300 mark as we, as we speak. And the mid-cap end of the market's also under pressure. Although they are, they have managed to pull back slightly from day's low, but still, 1.7% cut on the mid-cap index, and the Nifty Bank index as well has slipped below that 48,000 level, which was being looked upon as a key support level. Weekday, of course, as expected, in reaction to, the unrest or the escalation in tensions between Iran and Israel. Let's see how things pan out. But for now, of course, according to technical experts, it remains a buy on dip market. But with that completely timed out, thanks a lot for tuning in to Opening Bell. Stay tuned to Money Control for all your other news and updates, and have a good day.